Hello, I'm Charles Boettcher, Managing Director and Senior Portfolio Manager at City National Rochdale. Welcome to Market Perspectives. Major stock indices appeared not to have been spooked by the historically volatile months of September and October, continuing their respective advance for the year. As of filming, the S&P 500, the Dow Jones Dividend Select, and the Morgan Stanley All Country World Indices, just to name a few, are all comfortably in double-digit positive territory year to date. Since we last spoke, the Fed commenced, finally, on the highly anticipated path to lower Fed funds rates, cutting by 50 basis points at the September 18th meeting. The other hot topic is, of course, the election. This will be the last filming before November 5th, so this month let's focus on these two headline-grabbing topics: monetary policy and the election. As previously stated, the Fed cut the Fed funds rate by 50 basis points in September. City National Rochdale expects an additional 25 to 50 basis points before year end. We think there's a chance, given the election and strength of recent economic data, plus slightly higher recent inflation reads, that the Fed could stand pat in November. The pace of further easing is likely to be measured and data driven. Regardless of whether we get one cut or two cuts before year end, a multi-year measured easing cycle should be supportive for the economy and financial markets. Historically, stocks perform better when rate cuts are slow and steady. Such a pace generally suggests a proactive policy rather than one reacting to an economic concern or financial market shock. In other words, it is important why the Fed is cutting. Historically, if cuts are in response to a recession, the S&P 500 performance has been relatively weaker 3, 6, and 12 months after the first rate cut. In periods characterized as normalization, it has performed better. Cuts in response to an emergency measure relatively well because they usually follow a market that has dropped materially. Shifting to the election. With the days counting down to November 5th, polls and prediction markets disagree on the potential outcome. Traditional polling indicates a near even split with a slight lead to candidate Harris. Prediction markets like Polymarket and Kalshi show candidate Trump leading. Polymarket has seen a recent large influx in wagers, with speculation surrounding a mystery trade betting heavily on Trump. Critics argue prediction markets are influenced by financial stakes and may not accurately represent voter behavior compared to polls. The takeaway is the election forecast is cloudy and uncertain. You will recall multiple references to the three T's: tariffs, taxes, and treasuries. But what can we expect from a macro stock market perspective? Historically, the S&P 500 has experienced greater uncertainty and volatility in election years. Year to date, we have experienced a strong S&P 500, up more than 20% as of filming. But we have had some volatility. One period at the beginning of the second quarter, another starting in mid-July, and then a smaller drop at the beginning of September. Perhaps election uncertainty played some role. However, there were economic and financial factors as well. The key point of this chart is that post-election, the S&P 500 tends to trend back with non-election year behavior. And most importantly, presidential party control has had less of an impact on the stock market than many think. You've heard us say this many times. Corporate profits, interest rates, and the direction of monetary policy matter much more. All right, I look forward to putting those charts into storage until 2028. We are now entering into the heart of third quarter earnings season, and next month we'll shift our focus to how earnings season played out, if any revisions are needed to our earnings growth outlook, and importantly, is there any impact to the outlook for stocks? Until then, I'm Charles Boettcher with Market Perspectives. Take care.